Welcome to another investment management segment where we kind of want to recap a little bit of 2023 very briefly, yet focus more so on 2024 and beyond. One of the things that we're adamant about here at Credent Wealth from an objective and data-driven standpoint is that equity market participation is likely to provide the best results over the long term relative to fixed income or bonds, right? Bond market participation. And that's for numerous factors, mainly being interest rates are likely posing a greater risk than that of the stock market over the long term. And one of the ways that we gauge that from a broader trend standpoint, right, and making those assumptions and making those conclusions is by tracking our 10-year annualized rolling return numbers of the S&P 500, the Standard & Poor's S&P 500. And we have a great chart for you and analysis that we're sharing with you via this video. Alicia, walk us a little bit through our 10-year annualized return numbers as it relates to how things have panned out over the past, 90 plus years. And where are we at in terms of expectations moving forward based on just purely historical data before we actually focus on what may transpire?
Sure. So what we did in this analysis, we started back in 1937. And what this analysis shows is the 10-year annualized rolling return. So when we look at 2023, that's encompassing returns starting in 2014 through and including 2023. And what we see in this trend is a nice cycle, and the average return over this time period is 10.41%. But what's really interesting in this data is that when we breach that average on the upside, we tend to see sustained better than mean returns for an average of about 18 years. When we breached on the downside, it's usually more subdued returns for, on average, about 10 years.
Yeah, so you've all heard, right, long-term investing is best, better success that way, so on and so forth. There's empirical data out there to absolutely support that statement. What Alicia's saying is, once we've reached that long-term growth cycle of 10-year annualized returns above 10.41%, we tend to stay there for about 18 years at a time. And we started the current cycle here, what would have been roughly 2019 is when we started that cycle. So through roughly, call it 2035, or slightly around there, that is when the next cycle is projected to end, which means from our expected outcome, very positive long-term return profiles of the broader equity market, okay? This doesn't mean absent of short-term volatility, and it doesn't mean it's gonna happen overnight. The reality is the intact trend, which has been alive and well since 1937, which in that case, by the 10-year nature would have started in 1928, remains very, very well intact. As we do look at this over the next 5 years alone, we do see some marginal volatility with single to high single-digit returns in the markets, with better return profiles moving in the second half of that 5 to 15-year period. So, bottom line, stocks over bonds.
Exactly.
Over the long term, interest rate risk is going to possess, in our view, more risk than the stock market over the long term. Investors should weigh that in their decision-making capabilities and allow the long term to drive their decision profile.